You know, I've lived through 14 recessions now, 14, and I'll probably see another one or two before I'm done. That's just the way it works, you see. The economy moves in cycles, always has, always will, up and down, boom and bust, expansion and contraction. It's like the tide coming in and going out. You can't stop it. You can't change it. But you can prepare for it. And that's what I want to talk to you about today. How to prepare, how to position yourself so that when the next recession hits, and it will hit, trust me on that, you're not just surviving, you're thriving. See, most people get this backwards. They think recessions are times to hide, to pull back, to play defense. And I understand that thinking. I do. When times get tough, when the news is all bad, when your neighbors are losing their jobs, the natural instinct is to hunker down. But here's what I've learned over 75 years of investing. Recessions are when fortunes are made, not lost, made. Let me tell you about 2008, the financial crisis, the worst recession since the Great Depression. I remember watching the news, every channel, every day. Doom and gloom, banks failing, companies going bankrupt, people losing their homes. It was terrible, genuinely terrible. And everyone was scared. I mean everyone, smart people, experienced investors. They were all running for the exits. But you know what I did? I wrote an op-ed for the New York Times, October 2008, right in the middle of the crisis, and the title was, "Buy American, I Am." People thought I was crazy, maybe I was, but I saw something they didn't see. I saw fear, massive, overwhelming fear. And I've always said, be fearful when others are greedy, and greedy when others are fearful. So I bought. I bought Goldman Sachs, General Electric, Dow Chemical, Swiss Re, put billions of dollars to work when everyone else was pulling money out. And you know what happened? Those investments did extraordinarily well. Made Berkshire many billions of dollars, not because I'm smarter than everyone else, I'm not, but because I understood something fundamental about recessions. They're sales. They're clearance events for good businesses. Think about it this way. If you love shopping at a particular store and one day everything goes on sale, 50% off, 60% off, 70% off, what do? You load up, right? You buy more. But with stocks, when everything goes on sale during a recession, most people do the opposite. They sell, they panic. That's the opportunity. That's where fortunes are made. Now, let me be clear about something. I'm not saying recessions are fun. They're not. They hurt people. Real people lose real jobs. And if you're not prepared, if you don't have cash saved, if you're leveraged up with debt, a recession can destroy you. That's why preparation is everything. That's why the strategy matters so much. So let me walk you through, step by step, how I think about preparing for recessions, how I've done it for decades, how you can do it too. First thing, cash is king going into a recession. I know. I spent a lot of time in other conversations talking about how cash loses value to inflation, and that's true, it does. But there's a difference between normal times and recession times. In normal times, you want to be invested. You want your money working for you, but going into a recession, you want cash, you want dry powder, you want to be ready. See, when a recession hits, asset prices fall. Stocks fall, real estate falls, everything falls. And if you have cash, you can buy at those lower prices. But if all your money is already invested, you can't take advantage. You're just watching your portfolio go down, down, down. That's what I mean by dry powder. You need ammunition for when the opportunity comes. Now, how much cash should you keep? That depends on your situation, your age, your income, your risk tolerance, but I'd say at a minimum you want 6 months of expenses in cash. Maybe more if you're older, maybe more if your job is less secure. And for investing purposes, you want a separate reserve. Money you don't need, money you can deploy when stocks are cheap. I've always kept large cash balances at Berkshire for this exact reason. People used to criticize me for it. Warren, you're sitting on $100 billion in cash. That's wasteful. Put it to work. But I knew what I was doing. I was waiting for the right opportunity, waiting for the sale. And when 2008 came, I was ready. I had the cash. I could act while others couldn't. That's the first part of the strategy. Build your cash reserves. Second thing, and this is crucial, you need to know what you're going to buy before the recession hits. See, during a recession, emotions run high. Fear takes over, panic sets in, and if you're making decisions in that moment, you're probably making bad decisions. So you prepare ahead of time. You make a list, a shopping list of businesses you'd love to own if only they were cheaper. For me, it's always been about quality. Great businesses, strong balance sheets, competitive advantages, companies that will survive the recession and come out stronger. I'm not interested in buying garbage just because it's cheap. A bad business is a bad business at any price, but a great business at a discount, that's what I'm looking for. So you do your homework now, before the recession. You identify 10, 15, 20 companies you'd love to own. You study them, understand them, know what they're worth. And then when the recession comes, when prices fall, you already know what to buy. You don't have to think, you just execute. Let me give you an example from my own life. American Express. In 1963, there was something called the salad oil scandal. Sounds silly now, but it nearly destroyed American Express. A subsidiary had guaranteed some loans that went bad. The stock plummeted. But I knew American Express. I knew their brand was valuable. I knew people loved their charge card. I knew the scandal had nothing to do with the core business. So I bought, heavily, put 40% of my partnership's money into American Express. Everyone thought I was crazy. The stock was falling. The news was terrible. Why would you buy more? But I had done my homework. I knew what the business was worth, and I knew it was on sale. That investment made me many multiples over the years. I bought it, and I held it for decades, made Berkshire hundreds of millions of dollars. But here's the thing. To do that, I had to ignore the noise. I had to ignore the fear. I had to trust my analysis. And that's what I mean about psychology. You have to train yourself. You have to practice this mental discipline now before the recession so you can execute when the time comes. Fourth part of the strategy, and I can't stress this enough, never, ever use borrowed money to invest. Leverage is the enemy during recessions. I've seen more people destroyed by leverage than by anything else in investing. Here's what happens. You borrow money to buy stocks, maybe on margin. Maybe you take out a loan. Stocks are going up, so it feels safe. But then the recession hits. Stocks fall. And if they fall enough, you get a margin call. The lender wants their money back, so you're forced to sell at the worst possible time, at the bottom, and you lose everything. I've never used leverage in my personal investments. Never. And Berkshire uses very little leverage. It's just too dangerous because here's the thing. Investing is supposed to compound wealth over time. But leverage can wipe you out in a single event. And if you're wiped out, you can't compound anymore. Game over. Let me tell you about long-term capital management. This was in 1998. A hedge fund run by some of the smartest people on Wall Street, Nobel Prize winners on their team. They used massive leverage, and when things went wrong, when the Russian debt crisis hit, they almost brought down the entire financial system. Smart people, sophisticated models, didn't matter. Leverage killed them. So rule number 1, no debt, no leverage. Only invest money you won't need for at least 5 years, preferably longer. That way, when the recession comes, you can hold on. You don't have to sell. You can wait for the recovery, and the recovery always comes. Always. It might take a year, it might take 3 years, but it comes. Fifth thing, diversification matters, but not the way most people think. See, a lot of people think diversification means owning hundreds of stocks, a little bit of everything. That way they think they're protected. But that's not diversification. That's just confusion. You can't possibly understand hundreds of businesses. Real diversification, to me, means owning a handful of great businesses in different industries. Maybe 10, maybe 15 if you're really actively managing it. But each one should be a business you understand, a business you'd be happy to own for 10 years, a business with strong fundamentals, and they should be in different sectors. So if one industry gets hit hard in the recession, your whole portfolio doesn't collapse. For example, you might own a bank, a consumer goods company, a utility, an insurance company, a railroad. Different businesses, different economics, different risks. That's diversification, not owning 500 stocks you've never researched. And here's the thing about recessions. They don't affect all businesses equally. Some businesses actually do okay during recessions. Utilities, for example. People still need electricity, still need water, still need gas. Consumer staples. People still buy toothpaste, still buy food, still buy soap. These aren't exciting businesses, but they're stable, they're predictable, and during a recession, that matters. So a smart strategy is to overweight these defensive sectors going into a recession. Then once the recession hits and cyclical stocks get really cheap, you can rotate into those, but you maintain stability. You don't panic because you've got a foundation of businesses that keep performing. I remember during 2008, while the banks were collapsing, while the cyclicals were getting destroyed, my consumer staples holdings kept paying dividends, kept generating cash. Procter & Gamble, Johnson & Johnson, Coca-Cola. These businesses just kept doing what they do. And that stability, that consistent cash flow, it gave me the confidence to buy more of the beaten down cyclicals
because I wasn't worried about my entire portfolio going to zero. I had that stable foundation. That's smart diversification. That's how you position yourself for a recession. Sixth part of the strategy, and this is something I learned the hard way. Watch the balance sheets.
In a recession, companies with a lot of debt get into trouble. They can't make their payments, they go bankrupt, shareholders get wiped out. So you want companies with strong balance sheets. Low debt, lots of cash, solid credit ratings. I can't tell you how many times I've seen investors buy a stock because it looked cheap, only to watch it go to zero because the company couldn't survive the recession. It's not enough for a business to be good. It has to be financially strong too. So when you're doing your homework, when you're making that shopping list, one of the first things you check is the balance sheet. How much debt does the company have? What are their cash flows? Can they service their debt even if revenues fall 30%? If the answer is no, move on, find a different company. Because here's what happens in a recession. Weak companies don't just struggle, they disappear. And strong companies, they take market share, they get stronger. So you want to own the strong ones, the survivors, the winners. Let me give you a specific example. During the 2008 crisis, I looked at the major banks. All of them were struggling. All of them were down massively. But some had stronger balance sheets than others. J.P. Morgan Chase, for instance, Jamie Dimon had run that bank conservatively. They had capital, they had liquidity. So when I invested in the banking sector, I chose the strong ones, the ones I knew would survive. And some banks did fail. Washington Mutual, Wachovia, others. But the strong ones survived, and they came out of the crisis stronger than ever. That's the importance of balance sheets. That's why you have to do that homework. Seventh thing, and this is more philosophical, but it's important. You have to think long term. I mean really long term, not months, not even years, decades. See, recessions are temporary. They feel permanent when you're in them. They feel like the world is ending, but they're temporary. The U.S. economy has grown for over 200 years, and it will keep growing. There will be recessions along the way, but the long-term trend is up. So if you can think in decades, recessions become opportunities, not threats. Let me put it this way. Imagine you're buying a farm, a good farm, productive land, fair price. Now suppose the year after you buy it, there's a drought, crops fail, farm prices in the area fall 30%. Do you panic? Do you sell the farm at a loss? Of course not. You know the drought is temporary. You know the farm will produce again. You wait. That's how you have to think about stocks. You're not buying pieces of paper. You're buying pieces of businesses. And if they're good businesses, temporary setbacks don't matter. The long-term value is what counts. I bought Coca-Cola in 1988. Since then, we've had several recessions, the tech bubble, the financial crisis, the pandemic. Did I sell during any of those? No, because I bought Coke for the long term. I bought it because I believed in the business, in the brand. And today, that investment is worth many times what I paid because I didn't panic, I didn't sell, I thought long term. You know, One of my favorite quotes is from my teacher, Ben Graham. He said the stock market is a voting machine in the short run, but a weighing machine in the long run. What he meant was, in the short term, stock prices are driven by emotion, fear, greed, panic, euphoria. But in the long term, stock prices reflect the actual value of the business, the earnings, the cash flows, the fundamentals. So if you're a long-term investor, you don't worry about the voting machine. You focus on the weighing machine. You focus on owning good businesses, and you let time do its work. Eighth part of the strategy, and this one is maybe the most important of all, live below your means, always. Not just during recessions, always. Because if you're living paycheck to paycheck, if you're spending everything you make, you can't save, you can't invest, you can't prepare. And when the recession comes, you're vulnerable. One missed paycheck and you're in trouble. I've lived in the same house since 1958. Same house. It's a nice house, don't get me wrong, but it's not a mansion. It's not extravagant. I drive a regular car. I don't own a yacht. I don't collect expensive art. And it's not because I can't afford those things. It's because I don't need them. They don't make me happy. What makes me happy is security. Financial security. The knowledge that no matter what happens, I'm going to be okay. My family is going to be okay. And that comes from living below your means, from saving more than you spend, from investing the difference. So if you take nothing else from this, take this. Live simply, save aggressively, invest wisely. Do that, and recessions become opportunities instead of disasters. Now let me tell you something about lifestyle inflation. This is a trap I see people fall into all the time. They get a raise, they get a promotion, and immediately they upgrade their lifestyle. Bigger house, nicer car, more expensive vacations. And suddenly, they're not saving any more than they were before. They're just spending more. The smart thing to do when your income goes up, keep your lifestyle the same and save the difference. That's how you build wealth. That's how you prepare for recessions. I've known so many people over the years, high earners, doctors, lawyers, executives, making hundreds of thousands of dollars a year, but they have nothing saved because they spend it all. They live right up to their income, sometimes beyond it. And when the recession comes, when they lose their job or take a pay cut, they're in crisis because they have no cushion. Don't be that person. Build your cushion. Build your reserves. Live like you make half what you actually make, and invest the rest. That's how you get financial security. That's how you sleep well at night. Ninth thing, and we're getting near the end here, stay informed, but don't obsess over the news, especially during a recession. See, the news media, they make money from attention, and fear gets attention, panic gets attention. So during a recession, every headline is doom and gloom. Every story is about how bad things are. And if you're watching that all day, reading that all day, it's going to affect your judgment. It's going to make you scared. I read the news. I stay informed. But I don't let it dictate my decisions.
I focus on the fundamentals. What are the businesses I own doing? What are their earnings? What are their prospects? That's what matters. Not what some talking head on TV is saying. So my advice, limit your news consumption during a recession. Check in once a day maybe, get the headlines, but don't obsess. And whatever you do, don't watch the financial news channels all day. That's a recipe for panic. Trust your preparation. Trust your research. Trust your long-term strategy and tune out the noise. I remember during the dot-com bubble, late 1990s, early 2000s, everyone was telling me I was wrong. I was missing out. I didn't understand the new economy. The news was full of stories about internet stocks, day traders making millions, people quitting their jobs to trade full time. And I ignored it. I stuck to what I knew. I focused on businesses I understood, businesses with real earnings. And when the bubble burst, when those dot-com stocks fell 90%, 95%, I was fine, more than fine, because I hadn't gotten caught up in the mania. That's what I mean about tuning out the noise. The media creates narratives, and those narratives can be seductive, can be convincing, but they're often wrong, especially at extremes. So stay informed, but think for yourself. Don't let the crowd think for you. 10th thing in the strategy, understand the difference between price and value. This is fundamental. This is something Ben Graham taught me when I was just starting out. Price is what you pay. Value is what you get. During a recession, prices fall. Sometimes they fall a lot. But the underlying value of good businesses, that doesn't fall as much. So you get this gap, this disconnect between price and value, and that's your opportunity. Let me explain it this way. Imagine a business that consistently earns $10 million a year. In good times, the stock market might value that business at $150 million.
Let me explain it this way. Imagine a business that consistently earns $10 million a year. In good times, the stock market might value that business at $150 million. But during a recession, the stock price might fall to $80 million or $60 million. Even though the business is still earning close to $10 million, that's the gap. The price fell, but the value didn't fall nearly as much. And if you can buy when that gap is wide, you make extraordinary returns when the gap closes, when price and value converge again. That's value investing. That's what I've done my whole career. And recessions create the widest gaps, the best opportunities, so you have to train yourself to look past the price, to focus on the value. What is this business really worth? What will it earn over the next 10 years, 20 years? If you can answer those questions, then the current stock price doesn't matter as much. You know what you're getting. 11th part of the strategy, and this is something I don't talk about as much, but it's important, have an exit strategy, but not the kind most people think. I don't mean selling when stocks fall. I don't mean cutting losses. I mean, have a plan for how you'll use the money you make from the recession. See, when you buy stocks during a recession and they recover, you're going to have gains, maybe substantial gains. What are you going to do with that money? Are you going to take profits, reinvest, diversify? I tend to hold forever if the business is great, but some people like to take profits, rebalance, That's fine too. The point is, have a plan. Know what you're trying to accomplish. Are you building wealth for retirement, for your kids' education, for financial independence? Whatever it is, let that guide your decisions. Because investing without a goal, that's just gambling. You're just playing around. But investing with a clear goal, with a clear plan, that's how you build real wealth. 12th thing, and this might surprise you, don't try to time the recession perfectly. You can't. Nobody can. I can't tell you when the next recession will start. I can't tell you when it will end. I can't tell you exactly when to buy. What I can tell you is when stocks are down 30%, 40%, when fear is high, when everyone's panicking, that's a good time to buy. You don't need to hit the exact bottom. In fact, trying to hit the exact bottom is a mistake because you'll wait and wait and wait, trying to get the perfect price. And by the time you're sure the bottom is in, the market has already recovered. The opportunity is gone. So my approach is start buying when things are clearly bad. When stocks are clearly cheap, buy some. Then if they go down more, buy more. If they go down even more, buy even more. That way, you're averaging in. You're not trying to be perfect. You're just taking advantage of the sale. And over time, as the recovery happens, you'll do very well. Perfect is the enemy of good in investing. Don't try to be perfect. Try to be smart. Try to be disciplined. That's good enough. More than good enough. 13th part of the strategy, learn from history. Every recession is different. Different causes, different severity, different duration. But there are patterns. There are lessons. Study past recessions. Read about them. Understand what happened, what worked, what didn't work. The Great Depression, the 1970s stagflation, the 1987 crash, the 2000 tech bubble, the 2008 financial crisis. Each one has lessons. Each one shows you what not to do and what to do. For example, in the Great Depression, the people who held cash did well because deflation made cash more valuable. But in the 1970s, the people who held cash got destroyed because inflation made cash worthless. So the lesson is, context matters. You have to understand what kind of recession you're in. Is it deflationary? Inflationary? Is it a credit crisis? A demand shock? Different types of recessions require slightly different approaches. But the core principles remain the same. Own good businesses. Buy when others are fearful. Think long term. Stay disciplined. Those principles work in every recession. Every single one. So study history. Learn from it. Don't repeat the mistakes of the past. 14th thing, and this is crucial, have the courage to act when the time comes. This is where most people fail. They have the knowledge, they have the strategy, they have the cash, but when the recession hits, when stocks are falling, when everyone's scared, they freeze. They can't pull the trigger, they can't bring themselves to buy because it feels wrong. It feels scary. It feels like catching a falling knife. But that's exactly when you need to act. That's exactly when you need to overcome your fear and execute your plan. And the only way to do that, the only way I've found, is to prepare mentally ahead of time. Visualize it. Imagine the recession happening. Imagine stocks falling. Imagine the fear. and imagine yourself staying calm, following your plan, buying when others are selling. Practice it in your mind over and over. So when it actually happens, it's not new. It's not shocking. You've already been there in your mind. You already know what you're going to do. That's mental preparation. That's how you build courage. And courage is the difference between the people who get rich during recessions and the people who just watch it happen. 15th and final part of the strategy, be patient. This is the hardest part for most people because patience it's not exciting, it's not dramatic, but it's everything in investing, especially during recessions. See, when you buy stocks during a recession, they don't go straight up. They bounce around. They might go down more before they go up, and that tests your patience. That tests your resolve. But if you've done your homework, if you bought good businesses at fair prices, you just have to wait. The recovery will come. The businesses will perform. The stock prices will reflect that eventually, but it takes time. Sometimes years. I think about this like planting an oak tree. You plant the acorn, you water it, you protect it, but you don't dig it up every week to see if it's growing. You just let it grow. And one day, years later, you have a mighty oak tree. That's investing during a recession. You plant your seeds, you protect them, and you wait. And if you can do that, if you can be patient, you'll be rewarded. Now, let me bring this all together for you. Recessions are coming. I don't know when. Nobody does. Could be next year, could be 5 years from now, but they're coming. That's certain. And when they do, you have a choice. You can panic, you can sell, you can run for the exits like everyone else, and you'll probably lose money, miss the recovery, regret it later. Or you can prepare. You can follow a strategy. You can see the recession for what it really is, an opportunity. Build your cash reserves now. Make your shopping list of great businesses. Prepare yourself mentally. Avoid leverage. Think long term. Do those things. And when the next recession hits, you'll be ready. You know, I'm 95 years old now. I won't be around for many more recessions, but you will. You've got decades ahead of you, decades of cycles, decades of opportunities. And I really hope